Welcome, smart money traders. This is UJ Academy, the online university. Today's topic is on fair value gap, or you can call it the imbalance or the institutional reference point. It's a very important topic that you must know as a smart money concept trader or an ICT trader. You must know this topic if you must trade ICT. So I notice also that most of the terminologies that the ICT market is using is similar to the other strategy, just a little bit of twist in it. So without saying much, let's dive into the topic real quick. So on my screen here, there are four examples of fair value gap. There are four examples of fair value gap. I'm going to explain. Now, fair value gap, before I explain that, fair value gap is divided into two. We have the bullish fair value gap, which represents the buy. We have the bearish fair value gap, which represents the sell. Okay, now in this example, we have the first candles here. We have three candles, 1, 2, 3, and this 1, 2, 3. If you notice very well that the wick of the first candle touches the wick of the second candle, and the wick of, in fact, the third candle do not even have any wick. So there's no connection there's no connection between this third candle and this second candle. So this is a perfect fair value gap. The second one, in the second example, the first candle touches the second candle, and the second candle wick touches the third candle's body. So this is also a good example of fair value gap. Is a good example of fair value gap. So in this explanation, meaning that markets in no time will still come back to fill this void, at least touch this third candle before moving to its original direction. Same goes to this one as well. So let me explain that's for the bullish trend. The bearish trend is the same explanation. Now you can see the market printed three candles, the first, second, and the third. The first candle has a wick which is touching the second candle, and the third candle wick is not touching the first candle wick, leaving a void in between these three candles, meaning that in no time the market has to come back and fill this void before finally going to its original trend. Same goes to this one as well too. You can see three candles printed, 1, 2, 3, and the first one is touching with the second one body, but the third one is not even touching with the second candle body, leaving a void which market will surely come back to fill. So now, before we proceed to a live chat where I will show you how to spot a fair value gap, let me explain. Let me give you a further explanations and give you conditions that should be met before a fair value gap can happen. For a fair value gap to happen, there are three conditions that should be met. The first condition is that it must happen between three candles. The first condition is it must happen between three candles. You can write it down somewhere. It must happen between three candles. The second example is the second condition is there must be an imbalance. An imbalance means there shouldn't be a connection. Shouldn't be a connection between these three candles. There must be an imbalance or a void in which the market must surely come back to fill. The third example the third condition is there must be a void. Same thing as the second condition. There must always be a void for this candle to for this fair value gap to respect. So it's either the market is coming back to fill this void. Let me show you what I mean. Fill this void completely, or it's halfway. So there must be a void in which the market must surely come back to fill. So without saying much, let me quickly take you to the chart. I will give you 3 examples. I will give you first example from the currency Gpbusd USD, and then I'll still give you example from the stock. Those are trade stock volatility 75 index. So without saying much, let's dive into it real quick. So this is a Gpbusd. So this is the first live example I'm going to be showing you about a fair value gap. Sorry for that. So now in this fair value gap right here, this fair value gap, there are 3 candles that was formed. One, let me give you an example. There was 1, there is 2, and there is 3. You can see that there is a very strong void in this candle. Between here and here, there's a very strong void. And in that void, there is no connection between these 3 candles. So in future, even if it doesn't happen that time, this is a 1 hour time frame, even if it doesn't happen that time, just have it in mind that in future, market will always come back to retest that level again. So let me show you a clear example of what I mean. You can see this is a strong order block. So if you want to know more about Orderblock, there's a video that will show up here that will teach you about Orderblock. So there's a strong Orderblock here. You can see where the market actually came back to retest, to cover. You can call it retest. You can call it cover this void, to close this void before finally pushing up again. Okay, so that's a very good example of a fair value gap. Let me show you another example of a fair value gap. So this is another example of a fair value gap here. There was a printing, market printed 3 candles, 1, 2, 3, and while printing these 3 candles, it made an urgent movement upward. So in future time, the market still came back to fill that void. You can see, to cover that void that the market has given before pushing up again to a buy. Okay, so that's another example. Let me still scroll and show you more examples. So you can on your own, you can do this. You can do it as an assignment. Just go to your Gpbusd, any chart at all, whether any currency at all. You can just check and spot the fair value gap. So this fair value gap is very, very important to use it for your order block strategy or for your order block entry. So you can see this is another example too. Market printed 3 candles here, 1, 2, 3, and there's no mitigation, there's no connection of any sort between these 3 candles, and in future the market still came back to cover that void. So let me still go to the present candle, what is going on, present trend. Now you can see in this present trend right now, there was 3 candles that was printed here, 1, 2, 3, which gave a very strong buy. So you can see market is gradually, after making this kind of high, market is still gradually pushy to actually cover this void. Even if it doesn't cover it completely, maybe halfway, there must be an imbalance. You get, before the market will finally push up to a buy again. So that is fair value gap. So for you to spot a perfect fair value gap is, first and foremost, remember I told you there must be no mitigation. There must be no mitigation of any sort. There must be no connection of any sort between those candles. So if you're a smart money traders, you want to enter this kind of trade, you see this kind of movement. Let me give you an example. You see this kind of movement in the market, where markets made this kind of printing. All you need to do is just to patiently wait for the market to come back and fill this void. Even if it doesn't fill it or halfway, you can still use your Fibonacci extension tools to map out between this point and this point to get the 50% level. So once you get the 50% level, then you now pick a trade here. Or better still, you can still watch my video on Orderblock to learn how to create a perfect order block just like this one and know where the retracement will end and pick a trade here. So market has actually come back to fill off this void that he gave before finally pushing up again. So each time there is a fair value gap, a perfect fair value gap, there must always be markets coming back to retest that point. So market coming back to retest that point is called the institutional reference point. Sometimes it doesn't end in the 50%. Sometimes it clears liquidity downwardly, change of character before pushing up again. So this is a perfect example of how to spot. Let me still go to volatility for those that trade synthetic to spot a fair value gap there. So this is another example of fair value gap on the volatility 75 1 hour time frame. You can see that the market from here, there was a strong push upward, and all the candle that was printed here, there's no connection between them of any sort. So market actually came back to cover that void. You can see. So even here too, there's no mitigation. Remember I said for you to find a perfect mitigation, there must be connection between three candles. Perfect connections between three candles. They are weak, or their body need to be touching themselves perfectly. So if we check between here and here, from here to here, there is a very good IFC. There's a very good efficiency there in some parts, meaning that there is no imbalance there. So there's a little or no chances of market actually coming back to refill this place before pushing up. You can see market is actually pushing up. So where there is a void, where there's an imbalance, market must surely come back to fill up that void. So filling up that void, that imbalance, that space is called fair value gap, or the imbalance. You get? So you can see this is another example. This one is another example too. All this candle that is being printed here, there is no mitigation of any sort, meaning that in no time this trade or this movement, this candle must surely come back. You can see it's already making that move. Surely come back to cover this void, if not completely, before pushing up. Sometimes it clears liquidity downward to finally push up again. So that is a good example of fair value gap. So please guys, if you find value in this video, do well to subscribe to this YouTube channel. That's the only way you are supporting this YouTube channel. Many times I do research before I have to teach you anything that I'm teaching you here. So you can even tell from my voice that I'm already exhausted. I've done a lot of videos today. I'm already exhausted. So do well to subscribe, like, comment any topic you feel like you want me to teach. Please comment it on my comment section. I will definitely teach you that topic. All right, guys. Peace out.